pandemic has certainly created a variety of new issues for the venture capital private equity space, from fundraising to managing portfolio companies going through crisis or challenge, possible debt restructuring, and of course, the rise of federal assistance programs. Heidi, tell us how you, Threshold, have seen yourselves manage through these new activities, and perhaps maybe some commentary on the private equity venture capital community at large.
Sure. Well, first of all, and thanks again for having me. I think in many ways, when the crisis hit, we like many, and particularly those in California, we moved to a remote work situation, which we've now been in for, well, 10 months, I think. So we had to learn how to make investments without ever meeting owners face to face. And quite frankly, I think that adaptation has gone very well for us. I think we also, when things started to fall apart, we got out our playbooks from the dot-com bust 2009, and we said, hey, in situations like this, you really have to revisit your business plan, make sure it makes sense in the current environment, make sure that you have got runway. And interestingly, a lot of our companies are technology companies that frankly were not that impacted by the COVID situation. Some of them were, most of them were not. It turns out in retrospect that the whole concern about funding drying up was not true. And in fact, I would say there's a very robust capital market right now for early stage venture. And we're finding that our companies are getting preemptive offers and all our bids are competitive. And so that has, the fact that we're in this incredible crisis and yet the stock market's at an all-time high and we're seeing this sort of activity in the financial markets is surprising to us. And I think we're still skeptical that this will continue forever. And we're making sure that our companies have sufficient runway and are looking at runway now, because we don't think that they can just tap into the market whenever they want. The one thing I'll close on this is that we were not fans of having our companies take any federal assistance, PPP or otherwise, because our feeling about it is the intent of those were not for venture-backed tech risk companies with highly paid, highly educated employees. And not to say that all of our companies are highly paid, educated employees. I mean, we do have address a span of types of employees and all of that. So it was a very conscious decision to say we did not believe the intent of PPP was to support venture-backed companies. And most of those companies are either going to get more venture or go public or get acquired. And none of those look like the right arc to have taken this kind of federal assistance. And so some of our companies did, when I think that the merits were so clear, they were potentially never going to fundraise again. And it was, they really needed the money and could argue it. I think we used the typical test, right? If your company was outlined on the front page of the Wall Street Journal for having taken the money and described the kind of company, how would you feel about that? But the vast majority of our companies, we voted against having them take the PPP, and most of them did not.
Yeah. Interesting. Thank you. Good point. Fred, what are you seeing?
So it's interesting. I would say, similar to what Heidi said, I think we were a little bit surprised to watch how the rhythm of kind of the normal investment activities just kind of quickly migrated to screens. So whether it's investment company, board meetings, portfolio reviews, the LP meeting, which we actually did in a much more condensed version, which I think everybody probably appreciated, the onboarding of a class of associates, all of that kind of went rather seamlessly. And I think even, I work as an operating partner, and in our engagement model of kind of working with our portfolio companies to create their value creation plans and to figure out initiatives where we can help, that's all worked, I think, relatively consistently. The one thing that's been interesting that was different is probably for the first time, the pandemic for sure, and to some degree, all of the issues associated with the social and racial unrest of the country this year created a common set of issues across a very eclectic portfolio for the first time. And so as opposed to bespokely figuring out what a retail company needs versus a healthcare company versus a technology, we had this very, very common set of issues that they were all facing. And so we took a different approach, which is on each of those, and I'll just pick COVID as an example. We structured it into every company had to think about how to restructure their workforce. Every company had to think about how to work from home. Company had to think about how to return to work. Now they're all thinking about the introduction of vaccines. And so we essentially created a box library with a set of resources and best practices. We reached out into our ecosystem to find the very best people that we could, and whether that was professors who were neuroscientists at Berkeley that had real interesting insights on how to work from home, or the CEOs of a couple of our portfolio companies at Cushman and Wakefield that were seeing everything that was going on in the workplace, or the CEO of our urgent care business who's on the front line of testing. We were able to make those resources available and ran webinars and working sessions and town halls similar to these. And so it was a very different engagement model than I think we've ever used before, where we were able to affect the entire portfolio at once, as opposed to individually working with each company through its unique needs. We took the same tactic on the PPE front, and it's been an interesting year at investment committee. We went back and looked at, after the GFC, those couple of years after that were some of the best vintages in terms of investments that had been made in the firm. And so we've been very mindful about the fact that this creates a pretty interesting investment opportunity, although we believe kind of unsustainable nature of the insanity of the public markets continues to create unrealistic expectations relative to valuations. And so even though we have put as much money to work this year as we anticipated pre-COVID, which I don't think any of us expected, I think the number of deals that we have looked at in relation to the number of deals that we've closed is at a ridiculous ratio, because we've tried to be so disciplined about trying to think through valuation and not getting out over our skis. The one other just kind of random note that I would put in this, where we kind of capitalized, I guess, maybe on the crisis, is we use this as an opportunity to ask each and every one of our portfolio companies to work with us on identifying who was the break glass successor to the CEO and to the CFO and to the next most critical executive. And frankly, that's a database that we should have had and probably didn't have in aggregate. It gave us some real insights into where there was and wasn't talent. And so it was an interesting way that we, capitalized on, I think, answering an important and relevant question that was catalyzed by what we were all experiencing.
Very strategic point to make, I think, Fred, from the standpoint that while succession is always critical in portfolio companies, a crisis like this then sort of does crystallize where the immediate needs may be. And were you pleased? Were you a little bit surprised that there was continuity in talent, or were there some occasional gaps in talent?
I mean, across the growth equity portfolio, it's what you would expect. I mean, I think we were surprised in some instances around the depth and the creativity of how people thought about it. It reinforced the importance of being thoughtful about who's on your board, because sometimes the answer to that question would be a board member who would step in on an interim basis. And then there were others where we were just completely exposed and probably knew that was the case. It also led us to then reach out and be really thoughtful about, if we ran into that circumstance, how would we respond and who would we react to? And the good news is that, while we did have a couple of illnesses, nothing that required utilizing it, but it was still a good exercise to go through.
And an exercise for the future, right? Yeah. Thank you, Fred. Pat, given the transformations we've all seen this year, how has Neuberger and, again, the community writ large pivoted as you think about investment philosophies today?
Yeah, absolutely. Can you hear me okay?
Yes, I can.
Okay, fantastic. So, the interesting thing is, obviously, as we were sitting in our offices at March 15th, I think like the whole world, the last thing that we were really thinking about is what was our investment pace, what were our investments going to be. The primary focus was really kind of the the health of our colleagues, the health of our clients, the health of our GPs. And so it's been kind of amazing, really, to kind of Heidi's and Fred's points that they were making, is how much activity we've seen. So just to put some numbers around it, within the private equities business at Neuberger Berman, we are generally investing about $5 billion a year in funds and co-investments alone. That doesn't include our debt business, some specialty strategies like Dial and others. And so we didn't know what deal flow was going to be. And as we look at our numbers now through actually the most recent numbers, just through this week, we are at a faster pace than what we were last year. And so we've actually been, I think the number of deals we've seen is a smaller number. And I think that mirrors what we've generally seen in the M&A market generally. And most of what we're doing, most of our $5 billion in investments are mostly in the buyout and growth space, some special situations, but not as much on the venture side. And so I come to the table really kind of speaking about the stats there. And it's been amazing that we're at a faster clip, because one of the things that we've seen is that managers, and a lot of the managers that we invest alongside and invest in, they have a specialty. They have a specialization in a particular industry, a particular sector, a particular types of deals that they do. And what this market, kind of created, especially with, the stimulus that we saw coming in from a monetary standpoint, and even from a fiscal standpoint, what it did is that it actually created demand around a lot of these businesses in which they were either looking to buy, or in many instances in what they were looking to sell, like businesses like healthcare, like technology, all industries in which we invest a lot. And so as we look across the spectrum at our key GP relationships, either the big ones, and so we're investing alongside very large sponsors, like the TPGs of the world, but we're also investing alongside smaller emerging managers as well. And in both of these instances, you would have never thought that if you were going to have a year where you had 1918, 1929, and 1968 happening all at the same time, it would be a great year for private equity, right? Most times you would think any one of those things would have, could have torpedoed the market, but it just goes to show that this series and this cascade of events, alongside with just the way technology has allowed us to engage and to continue to do our work, and just kind of how advanced private equity is, and how much in the role that private equity is playing around the globe, has really kind of allowed the market to just recover. And even just from an investment standpoint, I mean, we looked at where the valuations of our portfolios first quarter, for the most part, they were kind of down, if you will, 10%. But then they were right back up again the second quarter, up 10%. And now as we look at 9/30, that quarter, they were up even more. And so overall, so not only has deal flow been positive, but our valuations, our portfolios have improved from where they were at 12/31. Again, you would not have expected this had you known, had you just seen the facts of just kind of the critical issues that have occurred this year. The other thing that I would say in terms of a pivot is, and then the other side of this, we sit in the middle, we're taking clients, big institutional, a lot of public funds and the like, their capital, they are partnering with us, or helping, we're developing portfolios for them. And then we're going out and investing in funds and doing co-investments with some of those sponsors. Our clients, our LPs, the big institutional investors, they too have actually been very active. We've closed many large portfolios on that side of the platform, with clients. So they too, having seen what happened from the financial crisis, where many pulled back and did not want to make investments in private equity, and they had a denominator effect. What you've seen this time is that they've been full speed ahead. And so you have not seen a pullback in turn from the big institutions, the big sovereign wealth funds and the like, to continue to make investments in private equity. In fact, they've continued the same pace. So you've got the capital coming in, you've got deals being done by very experienced managers in a private equity market that is very developed and advanced. And then the final thing I would make is that there have been some really, what I call kind of softer things that have actually created the opportunity for deals to occur. I mean, everyone, as you can see from this panel here, people have become quite facile with Zoom. So whether they're doing the diligence on a company, and in some respects, not having to get on a plane and fly across the country for, an afternoon of due diligence, in some respects has actually made it easier to do more due diligence. It's made it easier to get more people on your team, both the target as well as the acquiring firm. They have more of them in the room at the same time in order to do this work. And the same thing for our clients. And so, using a technology solution for much of this diligence, to do much of this work, in fact, it's actually expedited some of the deal flow that you would not have seen otherwise.
Thank you. So, Tarang, as we think about this current environment, and Fred and Pat and Heidi have all sort of either directly or indirectly referenced the importance of leadership and assessing organizational strengths and gaps, in what way do you foresee our new environment and how it will impact organizational design and strength?
So I definitely see a change in organizational design. And the first is team composition and openness to remote employees. I happen to be on a couple of different forums with fellow CEOs, often of other portfolio companies, PE-backed, and it's been amazing to see the transformation in a number of those CEOs who used to think adamantly that teams had to be together, that you couldn't collaborate unless everyone was in the office, et cetera. And it's not like it just takes one good pandemic to solve that kind of paradigm, break that paradigm, where you now have some CEOs that go like, gosh, I want everyone remote all the time. I'm probably somewhere in between where I do think there's value of having people come together, but it's really opened up our view in terms of available talent, because we've been able to hire. Our main two offices are in Oakland, California, and New York, which happen to be pretty high cost of living environments. We hired a regulatory director in Pennsylvania, and it's been incredibly effective since all of us are remote. So I think it's going to change the nature of organizations in the future with much greater openness to where people live and work. And I think that's going to be a good thing overall. I think the second thing that is really the pandemic's changed forever is the pace of digital transformation. So we happen to be a digitally native brand. We're founded 16 years ago, selling cosmetics over the internet for $1, which people thought was crazy. And since we've since migrated to other price points and other channels, we're in Ulta Beauty, Target, Walmart. One of the things we found is we're able to sustain growth in a category that's been really impacted by COVID-19. Color cosmetics is way down as a category overall as people's behavior has been constrained. Yet we've been able to, in the face of that post-growth, mainly because of that digital strength. So a lot of the investments we made early on in terms of our team, in terms of the infrastructure, are really paying dividends, not only on elfcosmetics.com, the #1 mass e-commerce site, but also our customer.coms. And what I see around me now is I almost feel like there's 5 or 10 years of digital investments that have accelerated as people have seen this migration. And a lot of this is going to be here to stay. So I think really assessing organizations and the strength in terms of how good are your digital chops, how good is the technology, how good is the consumer experience, and the underlying personalization, loyalty, and just a much greater emphasis. And it's not like people weren't focused on it, but there's just a magnitude of focus that I'm seeing that I never saw it this extent. And it's going to create a competitive marketplace as we think of everyone wants that talent and those capabilities. And then I'd say the last is really from a nature of how do you now manage more of a hybrid organization. And so we'll talk a little bit later about like all the different ways that we're connecting people that may be remote with people that are in offices, and how do we think about that and kind of the care and the things that we do there. So, I mean, there are going to be quite a few implications, but I think many of them will be positive for the future.